So here's the chapter 9 and 10 exercise. So once again, this is a review of everything that I taught you in chapter 9 and 10. And this is kind of what you should look for towards the exam. Okay? So, all right, so chapter 9, we have here number 1, on January 1st, you opened up your store and needed a petty cash fund. Okay? And for emergency expenses. Okay? And of course, you establish that $500 should be enough to cover the first months of opening for the first month's operations. Okay, so journalize this transaction. Okay. So right now it's January 1st, and you want to establish your petty cash drawer to be $500. So how do you journalize this?
You would debit petty cash and with checking with the credit.
Good. And it'll be for
500.
okay. And here you're going to make a note to establish petty cash fund. Okay. So then question number 2 says, at the end of the month, okay, you counted a total of receipts in the petty cash drawer, okay? And you had a total of $40.03 left of cash remaining in the petty cash. So let's go ahead and replenish the petty cash. So here is the petty cash drawer. Someone who was the manager made a record of who took money from the actual register and made calculations. So in this case, when we journalize to replenish the petty cash fund, how should we do this? How should we journalize the petty cash fund? The petty cash fund. Okay, now in this case, the receipts are specified. Okay. So if the first thing that happened was Drew took some money to buy some office supplies expense, okay, that was $20, and he came back with a receipt saying it was $19.85 and came back with 15 cents. So in this case, right, how would I replenish the petty cash drawer? If here's the list of all the expenses, right? And at the very end of the day, you have $40.03.
Wouldn't you add them all up?
Add them all up, okay?
I don't know. I tried to study on this one, but since I wasn't here, but I couldn't get that far.
Okay. Right. So, good. Brian is coming around with the right idea. You would add the total receipts up. So in this case, let's go ahead and calculate. What's the total amount of receipts that you have here?
Is it 11 or do you count the withdrawal?
What do you mean 11 or count the withdrawal? Like the total amount of receipts? Yes,
count the receipts.
yeah, the withdrawal.
It's 11 receipts. and there's a withdrawal, so would that be 12?
Everything, including a withdrawal, would be considered a receipt, yes.
Okay, so then there's 12 receipts.
Okay, there's 12 receipts. Can you journalize 12 receipts?
No, you add them up and do it as an expense, right?
Correct. Now, in this case, these expenses are specific expenses.
Then I'm a little lost too.
Okay. Anybody else want to give a shot?
So you would put them in their own like little expenses, so like office supplies expenses, meals expenses, business expenses.
Correct. Okay. So so in this case, let's get the main foundation here. How do you replenish a petty cash fund? Okay, so right now I have $40.03 left in my petty cash drawer. And in this case, Maribel recognized that there's 12 receipts, right? What's the total of the receipts? What's the total amount in receipts?
$475, I believe.
459, 459.97.
459.97. Okay? In this case, what's the grand total of my petty cash drawer?
500.
500. So in this case, right, if I only have $40.03 left in cash and I need $500 cash in my petty cash drawer, how much cash do I need to put into the petty cash drawer? Okay. If I have a whole bunch of receipts totaling up to $459.97 and I have a total of cash of $40.03, I need to replace those receipts with cash, right?
Is it with, 460 then, right? And then you have to find out where the missing part is or no?
Well, in this case, is there a missing part?
Not really, it's 3, oh no, it's not, the 3 cents, I didn't see that.
Okay. So in this case, no, it came out even $500, right? So that means I have to replace my receipts with cash. So in this case, because these are expenses that were not recognized during the period, right? Now they're being recognized because it's now time to replenish the petty cash drawer. So in this case, yes, I have to mark down each and every single individual account that's being used here, right? And the total amount that I'm going to be putting in or taking out from my checking account to put back into the petty cash drawer is $459.97. So let's go ahead and complete my journal. So it is now January 31st, right? The end of the month. You are replenishing the petty cash drawer. So we're going to recognize each and individual account. So in this case, office supplies expense was for $19.85. Okay, so that's my very first account that I used. Okay, for $19 and was it 85 cents? Okay, that was the very first account I used. Next account here is that Susan took out some business expenses for $54.17. So right there, right, I got some business expenses for $54.17. Right? So then let's see what happened next. Then Mary, right, took some money out to pay for some meals expense. There was a board meeting or something like that, staff meeting. We had to buy meals. So for $35.22. So there you go. Meals expense for what was it? For $35.22. Okay. So then let's see what happened next. Then we had a delivery expense, right? Harry decided to take some money out for delivery expenses for $50. So here I have to recognize that there's a delivery expense.
We have meals before delivery.
Let me see. It's 2 meals. Okay, yeah, thank you. Okay, so then Susan then took out another meals expense, okay, for $15.65. So then I need to add that to my current meals expense, right? What is 35.22 plus 16 or 15.67?
5089.
50.89. Okay. Okay. And we got delivery expense for $50. Okay. Let's see what the next one is. So then Harry also took out some business expenses for $22.78. Okay. $22.78. So we need to add that to our business expense account for $54.17. So how much is that? 76.95. Okay. See what else happened here. I think I'm on the wrong spreadsheet, but let's see. Let's continue. So we got business expense. Okay, so then we have Drew taking money out to order office supplies for $6.95. Okay, so let's see. We currently have an office supplies expense for $19.85.
2680.
Okay. So then after that office supplies, we had another delivery. We got Mary taking out another delivery expense for $100. Okay, so delivery expense for another $100. That becomes $150. Okay. Let's see. Next was Susan taking money out for advertising expense for $50. Okay. Okay. Then we have Harry taking out another delivery expense for $25. So $25 to delivery. So this makes it 75. Okay. Then we have Susan doing a business expense for $30.33. Okay. So we see business expense is currently $76.95. So what's my grand total there? 107.28.
Yes.
107.28. Okay. And then last but not least, we had an owner taking money out from the petty cash drawer for $50. So owner's draw for $50. Okay. So therefore, how much in grand total should be the money that I'm going to be taking out from my checking account?
$459.97.
Good. All right. And then my note here is to replenish petty cash. Okay. You can write it for January's expenses. Okay. All right. This is exactly what I want you to know. If you are going to be journalizing this, I will ask you this exact question to just know how to establish a petty cash fund and how to replenish it. So in this case, right, we see how much money is left over in the pot of money, right? And then we make sure that there's no shortage or overage. And then from there, right, we figure out how many total number or receipts that are there. So including withdrawals, those are considered receipts. Right? All of the total amount of receipts that are in that cash box, and you're going to replace those cash receipts or those receipts with cash. Okay? Is everyone okay with this one now?
Yep.
Yeah.
Okay. So then on June 1st, right, your business begins to pick up, and in the last few months you are running low on the cash in your petty cash drawer. So you decide to increase the petty cash by $300. Record this transaction. How do I increase my petty cash drawer? If in January I have it currently at $500 and I want to increase it by $300, how do I increase my petty cash drawer?
You would add checking.
You would add to checking. You wouldn't add to checking because here we're trying to increase the petty cash drawer.
No, I thought I meant to add a check from checking.
To
Increase
add,
the cash.
okay, to add, okay. So what account am I putting that check in?
Petty cash.
Yes. By $300. And I'm going to make a note here to increase petty cash fund. Okay. Then at the end of the year, okay, you decided to get rid of the petty cash drawer and use a business credit card, okay, for all minor expenses. Record the close of the petty cash drawer. So again, at the end of the year, so it's December 31st, you decide to close out the petty cash drawer.
Checking account to petty cash.
Good. For how much? For
800.
$800. Good. So in this case, you're not going to pocket the $800 and carry it wherever you want to go. You're going to put it directly into your checking account. Okay. And my note here is going to be to close out petty cash fund. So again, that's what I will be testing you on, how to establish a petty cash drawer, okay, and then to replenish it. Where the concept of increase and decrease, where increase or close out, those are standard given. You should know how to do that. Okay. So then questions 9 through 10 are related. Okay. 5 through 10 are related. Okay. So then on June 15, customer A, right, decides to purchase a total of 100 toys for $5 each on an account. Okay. Sales tax is 8.25%. Record this transaction.
You would debit account payable and credit sales tax.
Accounts receivable, right? Because that's when customers owe you the money.
Oh yeah, whoops.
Sales and sales tax. Good. So if I sold 100 toys at $5 each, what's my grand total amount of sales?
500.
Okay. 100 at $5 each is 5. Okay. And then how much tax should I be charging?
$41.25.
So in grand total, how much does customer A owe me?
$541.25.
Okay. Your note will be sold 100 toys to customer A. Okay. Then on July 15, okay? 15, okay? We received payment, okay, check for $50 from customer A. Record this transaction.
Debit checking,
Okay.
credit, account receivable. 500.
For not 500, it's 50. Right. So this person is giving us payments. So again, we don't charge interest until maybe a year later or something. Maybe give no interest, 0 APR. So in this case, okay, received payments, PMT, from customer A. Okay. Then on August 15, customer A refuses to pay for the remaining amount that she owes. Okay, record this transaction.
No transaction.
In this case, she refuses to pay for what she owes.
No transaction.
Okay. There is a transaction, right? If someone refuses to pay and they owe you money, what do we call that?
A bad debt?
Potential bad debt. Okay. So if there's a potential bad debt, what account do we use?
Bad debt expense.
Not bad debt expense. That's towards the end of the year when there's an estimated amount. In this case, we know exactly who. We know exactly that customer A on August 15 owes us exactly amount of money, and we know exactly how much. So in this case, this is during the year.
Doubtful.
Allowance for doubtful accounts. Allowance, we're missing something for doubtful accounts. Okay, good. And where does this amount get written off from? Or it gets taken out from?
Accounts
Account
receivable.
yes.
Yes, good, right? When you know someone is not going to pay, you want to kind of focus it and put them in a placeholder account to keep an eye on this person, right? Because it's considered potential bad debt. You have a possibility of this person continuing to make payments, or you have a possibility of never collecting it. So in this case, how much does customer A owe me?
Oh, 541 minus 459.75.
Anybody else?
Do we not include the tax?
That does include the tax, does it not?
So 491.25.
491.25. Okay, how did you get that number?
Because the total cost of the 100 toys that, well, I said customer A bought was $541.25, and she only paid $50.
Good.
So if I minus $50 from 541,
Good. Right? You have to include the tax too. 25. Okay, good. Right? This time she owes me a total of $491.25 because you have to include the tax as well. Okay? Now in this case, so she still owes me $491.25. Okay? And I'm going to go ahead and say to remove customer A's accounts receivable. Okay? So then number 8, right? We contacted customer A to retrieve the debt that she owes, okay? And then October 20th, okay, we received a pay of $15 from customer A, okay? Record this transaction. So after X amount of months we've been hassling her, she decides to give us $15.
Read. We have to go back to the account receivable and doubtful count allowance.
So you said you have to go back to, what do you mean by that? We have to reverse it, right?
Yes.
Okay, so we have to reverse the amount because in this case, right, if you remember from the previous one, right, if you deactivate an account, right, you need to reactivate it in order for you to process the rest because now she has the capability to keep continuing paying for us. So in this case, we need to activate her account. So we're going to put the money back into the put the whole entire amount. So right now, for 91.25, okay, is what she owes. Okay. Now we need to also record the payment of $15.
Cash or check?
Yep, I didn't specify, so in this case, cash or check. Okay.
To doubtful. Allowance for doubtful account.
It will not come directly to allowance for doubtful accounts.
To account receivable.
Yes, right, because she's paying for what she owes.
Yes.
Okay, and it's for $15. Okay, and then make a note here. Received payment from customer A. Okay. Number 9 says that on November 28th, okay, a debt collector informs us that customer A has filed for bankruptcy and can no longer pay. Record this transaction.
So you would reverse it again.
Correct.
Right? Okay.
Yes.
So account receivable and the allowance doubtful accounts.
Yeah, you got to do the allowance first because that's the account that we're moving it into because we already reversed it. And we are removing it from accounts receivable. Okay? So in this case, how much does she owe me now?
476.25.
476, sorry. 476.25. 476.25. Okay? And then once again, to remove customer A's account receivable. Okay. So then on December 31st, right, our company estimates that $2,556 out of the 200,000 accounts receivables is to be uncollectible. And there is currently a debit balance of $476.25 in the allowance for doubtful accounts. Record these adjustment. So now I reach the end of the accounting period, right? I'm making an estimated amount. So how should I journalize this?
With bad debt expense and then with the allowance for doubtful accounts, right?
Correct. Bad. Okay. Now in this case, what is my grand total amount? How much do I need to journalize in regards to the total amount of bad debt and the total amount of allowance for doubtful accounts? In this case, what method am I using to be able to calculate this number?
with the allowance method.
The allowance method, good. Now, the allowance method is split into two more methods, right? The balance sheet method or the income statement method. Now, under the allowance method, right? Under the balance sheet method, right? There's a keyword that I'm looking for versus the income statement. There's another keyword that I'm looking for. All right. How do I know which method to use?
Account receivable.
Accounts receivable, right? When we talk about the balance sheet, right? Accounts receivable is a asset. So that's going to appear on the balance sheet, whereas the income statement only deals with income and expenses. So accounts receivable does not even appear on the income statement method. So in this case, we recognize that we're using the balance sheet method, okay? Now, what's the rule when it comes to the balance sheet method? I found my estimate of $2,556. I know that there's accounts receivable, but what does it mean? Do we care about what the amount is in the allowance for doubtful accounts?
No, you should care. So wouldn't you add them up?
No.
Wouldn't you add them up? What gave you... So in this case, right, the rule is if there's a debit, you add the amounts together. If it's a credit, you subtract. So in this case, yes, you do add the $476.25 to the $2,556. So in this case, what is my total amount that I'm going to debit?
30, 32, 25.
30, 32, 25. Right? And then right here, to adjust for bad something like that, okay? To adjust the bad debt at the end of the year. Okay? Good. Good. All right. Now, what I'm going to be testing you on is not going to be any of this, right? It's just so you know where the balance for the allowance for doubtful comes from, okay? Because a lot of students had questions, where did the balance in the allowance for doubtful accounts come from? Well, there you go. So then the next time you do your adjusting for balance, right now you currently have a $3,032.25 allowance for doubtful accounts currently as a credit. Okay, so that's where that number comes from. Okay. All right, so there you go. Next, so the ones that I want you to focus more on is going to be the next 4 questions because this is what I will be testing you on, okay? Just knowing the difference between the different allowance methods, okay? So here on December 31st, your company estimates that $2,430 of a $500,000 total credit sales is to be uncollectible. And there's currently a debit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry will be, so again, 12/31st, right?
So you would still use bad debt expense and allowance for doubtful accounts.
Correct. You would still use this exact accounts, okay? However, how are you going to calculate this one? How are you going to calculate the amount that you're going to journalize?
but you still add the 2,430 with the 1,500.
So in this case, right, which method am I using? So in this case, right, I have total credit sales. Does the allowance for doubtful accounts appear on my income statement?
Yes.
No.
No, it doesn't,
Oh,
because this one's only focusing on your revenues and your expenses, right? The income statement. So in this case, no, the accounts receivable and the allowance for doubtful accounts does not appear on the income statement. So in this case, right, I don't care what balance I have in my allowance, because it doesn't matter to me. All I care is about what my total credit sales was. So in this case, the estimated amount was only $2,430. So the only number I care about here is just my estimated number for my total credit sales. In this case, $2,430. Okay. All right, so let's go ahead and keep practicing. Down below on December 31st, okay, your company estimates at $2,430 of a $500,000 accounts receivable, okay, is to be uncollectible. Okay. There is currently a debit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry will be okay, the journal's the same, but this time, how am I going to calculate how much my journal should be written out for?
okay.
3,930.
What was that, Magdi?
The estimate plus 1,500.
Okay. Gives you, what's the total amount there?
3,930.
Okay. So in this case, right now we have right here where it says accounts receivable. That tells us we're gonna be using the balance sheet method. Now in this case, like we mentioned earlier, right? If there's a debit balance, we add. If there's a credit balance, we subtract. In this case, I have a debit balance, right? I'm all the way on the right side. I mean on the left side. How do I get from the left side to the right side? Okay. And in this case, you need to add it because you have to backtrack, right? If you're on the left side, how do you get to 0? When you get to 0, then you need to go, how much more you need to go right? Okay. So there you go. All right, good.
Teacher, I have a question
Yes.
on this 12. The estimate always debit balance. Your company estimate always debit balance?
No, always your company that estimates this number here is always going to be a credit balance, because it's the allowance for doubtful accounts. It's a contra account, right?
Yes.
So a contra account is the opposite flowing in direction. If the allowance for doubtful account is a contra account to account receivable, what should be the balance in there? It should be a credit balance.
In question 12, this 2,430, it is debit or credit? It is debit because we add debit plus debit.
No, it's not. You need to get to $2,430 on the credit side. That's the end goal, is you need to be at $2,430 on the right side. But how can you get there if you're on the left side of 1500? So in this case, if you draw it on a number line, right? If you're on the left 1500, how many do you need to go right in order to get to 0? 1500, right? But you're at 0. Your end goal is to get to 2430. So how many more do you have to go to the right? That's why you have to add those two numbers together, because if your end goal is you're trying to get 2430 on the credit side.
But bad debt expense, it closed on the profit and loss account.
Yes, the bad debt expense, yes, that's completely separate, but this is the allowance for doubtful accounts account that we're focusing on. This estimated amount is for your allowance for doubtful accounts, not your bad debt. Your bad debt's whatever going to be the amount that you're going to write off.
You mean there is a currently a debit balance to be credit balance? You mean?
Yes.
Thank you.
Yes. Okay. So remember, this number comes from whatever happens during the year. So in this case, every business has its own per case scenario, right? If you have a whole bunch of people that owe you money, what are the chances that you're going to be owed money and that person's not going to pay you back? Right? So in this case, this number here where you have a debit or a credit balance, a current balance, is going to be determined what happened during the year. Okay, just like what we did in the scenario, right? We were dealing with customer A, and customer A owed us money and wouldn't refuse to pay us back until we finally, exercised as much as we can until someone told us that they can't pay us back anymore. Right? And then we end up with a debit balance of $476.25, right? That was my debit balance in the allowance for doubtful accounts. But I have to remember, customer A isn't my only customer that could fault on their payment. So that's why the estimated amount, this bad debt, is based on how much you think that the company will not receive money. It's just a rough estimate. Okay. All right. So then question number 13 says that on December 31st, your company estimates that there is 2,430 of 500,000 accounts receivable that are uncollectible. And there's currently a credit balance of $1,500. All right, in the allowance for doubtful accounts. So now the adjustment will be so here right now you're saying that you are already on the right side, 1,500 in already, right? And your end goal is you need to get to 2,430. So how many more do you need to go on the right side from 1,500 to 2,430?
The difference between 2,430 and minus 1,500.
What was that? $930. Okay? It's the difference. Correct. Okay? All right. So then, question number 10 says that on December 31st, okay, the company estimates that $2,430 out of its 500,000 total credit sales is to be uncollectible. And there's currently a credit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry will be so in this case, are we using the balance sheet method or the income statement method? income statement. So in this case, what number do we only care about?
Just the credit sales.
Good. So in this case,
It'll just be 2,430.
correct. Okay. Right? And so again, these four, I want you guys to focus on that, right? Practice so you know the difference, so you don't get this wrong on the exam, because a lot of students will get confused and they will make their mistake there. Okay. All right. Question 15. All right. So here we got some simple interest for you. All right. So in this case, right, I thought I did this in Excel, but let me go in and pull up an Excel sheet for this.
I'm just gonna use the bathroom.
Oh, okay.
Quick.
That's fine. So then here, right, I am going to be calculating these amounts over here. Okay. So I'll say I did have it Excel way. All right, so here we go. We are on question 11. No, not that one. We're on question 15. All right. So let's go ahead and figure these numbers out. So if I have a total principal of 28,000 at 4.35% for 150 days, okay, what is my total interest and future value? Okay, so this is simple interest calculation. So how do I solve for my interest? What's my formula here?
Was it just principal times rate?
Principal times rate times time, right? Pretty, like PRTI. Okay? So in this case, it's principal times rate times time. Now in this case, my rate is in an annual rate. What about my time? It's 50 days. Can I just multiply this across?
No, you gotta make it into the decimal version.
Yes, you have to make it in terms of years. So in this case, 150 days. So if 30 days equal 1 month, okay, then 150 days is equivalent to 5 months, right? And then, of course, what is 5 months compared to 12 months? That's the number you need to look for. Okay, so in this case, whatever 5 divided by 12 is. Okay. So in this case, how should I calculate this? My interest is going to be principal of 28,000 times my rate of 0.0435, okay, times, easier way to do it, just plug it in, 5 divided by 12, and that should work too. Okay. Because if you to plug in this decimal, you might be off by a few numbers. Okay. So in this case, what's my total interest I have to pay?
Is it 500? $507.50.
507.50. Okay, good. So then what is my future value going to be? 28,507.50. Okay. So let's go ahead and do the next one. If I have a principal of $5,147.50 and my interest rate is 6% and I have 10 years, what is my total interest I'm going to be collecting?
$3,088.5.
3,088.5. So then that makes my future value be $8,236 even. Okay. Last one we have here is if my principal is $600,084,150, all right, and my interest rate is 3.49%, and it's for 8 months. Okay, so in this case, 8 months. So therefore, what should be my interest here? Good. Making my future value become 700,067.89 cents. Okay. Excellent. Okay. So, question 16. Hold on, I thought I have you practice. Oh yeah, question 16. All right. We're going to be doing, so that's what I'm going to be having you guys do is just simple interest. Okay. Question 16 is going to be a bank reconciliation. Okay. So once again, we have the bank side and the cash side. This is what's going to look like on your exam, exactly how it is, because Orban doesn't let you put pictures in there. Okay. They let you put tables in there, but this is what's going to look like, right? You're going to have one table that has your bank statement on there with the total, like the ending balance, your total deposits, your total checks, and your interest and your fees, okay? And you're also going to be receiving a second table, which is your checking account. So your checking register, right? That's the only two tables you're going to have. And then, of course, you're going to have your blank table here that's going to have your comparison between the bank and the cash. So in this case, what do you guys want to start with, the bank or the cash?
Bank.
Bank, okay? So in this case, what is the ending balance in my bank account? $850. Okay? What do I need to add on the bank side?
Deposit.
You need your deposit. So let's take a look at my deposits. Okay? So in this case, I have deposit 44, 45, 46, and 47. Which one cleared in my bank?
No 46, no 47.
Okay, so 46 and 47 did not clear yet. So that's for 300 and 750. Okay, so deposit number 46 for 300. And then we have deposit number 47 for 450. I think so.
Yes.
Okay. All right. And then what do I need to subtract?
Checks.
Outstanding checks. Good. So let's see how many checks I wrote. I wrote check 101, 102, 103, 104, 105. Which ones have cleared?
1, 2, 3 means 4, 5 doesn't clear.
Okay, 4 and 5 did not clear yet, so I got 104 for 50 and 105 for 125. Okay, so 104 for, in this case, I'm going to use parentheses so you guys know to subtract. So that's 50, okay? And then I have check number 105 for 125. Okay? So in this case, right? What's my adjusted ending balance here?
$575.
1600.
Okay, guys, 1600 and I got 500.
1600 minus 50 and minus 125.
175.
I got 1425.
1425. Okay, so let's see. 850 plus 300 gives you 1130. Okay, plus 450 gives you 1600 minus 175 gives you 1425. Okay. So that's just that on one side. We need to make sure we need to calculate on the cash side to make sure that they balance at the end. So in this case, what is the ending balance in my cash ledger?
$1,410.
1410. Okay, oops. Okay, so what do I need to add into my cash side?
Interest and ACH.
Good. Interest and ACH. Okay, so let's take a look. On my bank side, I have interest for $25 and ACH for $175. Okay. So interest for $25 and my ACH for $175. Okay. What do I need to subtract from my cash side?
Fees.
Fees. So let's check out what fees I have. So here I have a service charge of $100. I have an NSF fee for $50, and I have a return check fee for $35. So $150 and $35. So in this case, less service charge for $100. Okay, I have NSF fee for $50. And then I have a return check fee. for $35. So in this case, what is going to be my adjusted balance here?
1425.
$14.25. And do we match on the bank versus the cash on both sides?
Yep.
Yes. So that concludes what you're going to be expected to know on the exam. Okay? I'm only going to keep it really sweet and simple, right? I'm testing you on your do's and your ifs. That's it. Okay? Any questions in regards to the chapter 9 and 10 review?
Yes.
Go ahead.
Question 14 and 15.
14 and 15.
Yes, this is my question. When I have to put the estimate
Okay?
amount without any add or minus the credit balance or debit balance, when I have like this in 14.
When you see total credit sales. Right here. Total credit sales.
What is the key? My question, the keyword.
Total credit sales. Okay, so the difference here is you have this amount, right, of total credit sales, where number 13 says total accounts receivable.
Yes, this is the key.
That's the key word right there. That tells you whether you're using the balance sheet or the income statement method. Okay, so in this case, right, question 14, you have total credit sales. Does the account receivable and then the allowance for doubtful accounts appear on the income statement? No, it doesn't, right? Because it's only focused on your revenues and your expenses. There's no account receivable in there whatsoever, right? Because that account receivable is an asset, right? If you're focused on your revenues and your expenses, an asset's not going to appear. So in this case, that's what the key word is total credit sales. Okay? And then question 15.
No. Just this mistake. I question on 14 and 13.
Okay. All right.
This go to the 13. This total credit, this 13 it is account receivable.
Mm-hmm.
And 12, yes, also account receivable.
Mm-hmm.
Because we add the estimate and debit balance.
Mm-hmm.
This is we add the estimate plus the debit balance.
Mm-hmm.
And on 13 we make difference.
Mm-hmm. Because you already have a current credit balance. How much more do you need to get to 2,430?
Thank you very much.
Mm-hmm. Okay. All right. So let's see the time here. So it's exactly 9:41. So go ahead and take your 20-minute break and please be back no later than 10 o'clock. Okay. And we'll start chapter 11.1.